Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about real estate versus stock market. Which one will make you more money? Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. Let's get into the video. The stock market has long been a popular area for investors to put their money. While stocks are a well-known investment choice, many people are unaware that purchasing real estate is also a viable option. Real estate in the right circumstances can be a viable alternative to stocks, giving lower risks, higher returns, and greater diversification. Individuals require an investing strategy that meets their budget and needs, whether they are planning for retirement, saving for a college fund, or collecting residual income. A smart place to start is to compare real estate investing to stock investing. Whether you invest in real estate or stocks is a personal decision that is influenced by your financial situation, risk tolerance, investing goals, and investment style. It is safe to suppose that more people are investing in the stock market, probably because buying equities takes less time and money. If you want to buy real estate, you will need to save and put down a significant sum of money. When you buy stocks, you are purchasing a little portion of a firm. In general, there are two methods to profit from stocks: value appreciation, when the company's stocks rises in value, and dividends. When you buy real estate, you are buying a piece of land or a piece of property. Rents, which can provide a consistent revenue stream, and appreciation as the property's value rises, are how most real estate investors generate money. Furthermore, because real estate may be leveraged, you can extend your holdings even if you cannot afford to pay cash upfront. Real estate appeals to many potential investors because it is a physical asset that can be controlled while also providing diversification. Real estate investors who purchase property have a tangible asset for which they can be held responsible. Real estate investment trust REITs are a type of real estate investment that may be bought and traded like stocks. When deciding whether to invest in stocks or buy real estate as an investment, investors must examine a number of factors. When combined with incentives that improve your profits, like as corporate matching in a 401k, investing in the stock market makes the most sense. However, those benefits are not always available, and the amount you may gain from them is limited. Investing in the stock market on your own is risky, and the return on investment is sometimes lower than anticipated. Comparing real estate and stock market return is an apples to oranges comparison because the factors that influence pricing, values, and returns are vastly different. The 2008 housing bubble and financial crisis resulted in a loss of value for real estate and stock market investors, and the COVID-19 crisis is doing the same thing, a bit for different reasons. Still, it's vital to keep in mind that the dangers associated with equities and real estate are vast different. There are a few things to think about when it comes to real estate and the hazards involved. The most significant risk that individuals overlook is the fact that real estate demands extensive investigation. It's not something you can do on the spur of the moment and expect to see fast benefits. Real estate is a difficult asset to dispose, and it is difficult to cash in rapidly. This implies you won't be able to cash it in if you are in a pinch. There are hazards involved in conducting repairs or managing rents for home flippers or individuals who own rental homes. The cost, as well as the time and stress of dealing with tenants, are some of the most significant difficulties you will face. You may not be able to postpone them if an emergency arises. As an investor, you may want and need to hire a contractor to handle your flips, repairs, and upgrades, or a property manager to monitor your renters' upkeep. This may diminish your profit margins, but it does cut down on the amount of time you spend monitoring your investment. The stock market is exposed to a variety of hazards, including market economic and inflationary concerns. First, stock prices are subject to market swings. Thus, their values can be quite volatile. Geopolitical and company specific developments can both generate volatility. If a firm has activities in another country, its foreign division is bound by the laws and regulations of that country. However, if that country's economy suffers or if political unrest occurs, that company's shares may suffer. Stocks are affected by the economic cycle as well as monetary policy, regulations, tax adjustments, and even changes in a country's central bank's interest rates. Other dangers could come from the investor. Investors who do not diversify their portfolios are putting themselves at higher danger. Consider the following. Dividend paying stocks can provide consistent income, but a significant investment in a high yielding dividend stock would be required to create enough income to fund retirement without selling additional securities. Investors that rely primarily on high yield dividends may miss out on prospects for higher growth investments. Real estate investors can gain a lot of leverage on their money while also getting a lot of tax breaks. Although real estate is not as liquid as the stock market, it provides long term cash flow and the potential for gain. Regardless, the amount of money that goes into real estate investments must be considered. If you ain't doing all cash deals, you must be able to get a down payment and financing. You cannot count on selling your assets quickly when you need them because real estate isn't as liquid. Other drawbacks include the cost of property management and the time spent on repairs and maintenance. Pros: passive income, tax advantages, inflation protection, ability to leverage. Also, more work than buying equities, expensive and illiquid, high transaction expenses, no certainty of appreciation. Stocks, advantages and disadvantages. For most investors, getting started in the stock market does not require a large sum of money, making it an appealing option. Stocks, unlike real estate, are liquid and can be purchased and sold quickly, so you can rely on them in an emergency. It can be simply to establish a well diversified portfolio with so many equities and EFTs to pick from. However, as previously stated, stocks are more volatile, making them a riskier investment, especially if you panic sell. If you sell your stocks, you may be subject to a capital gains tax, which will increase your tax burden significantly. Your holdings may not be able to expand significantly unless you have a lot of money in the market. The pros are high liquidity, easy diversification, low transaction fees, easy addition to tax advantage retirement accounts. The cons is less stable than real estate. Selling stocks might result in hefty tax bills. Some stocks go in and out of favor for years. Emotional investment has the potential to be profitable. Purchasing a home necessitates a large initial investment than stocks, mutual funds, or even REITs. When acquiring real estate, however, investors have more control over their funds, allowing them to purchase a more desirable investment vehicle. If you invest $25,000 in securities without using margin, you will receive $25,000 in value. Alternatively, the same real estate investment may buy around 125,000 in property with a mortgage and tax deductible interest. The rent will be used to pay for the mortgage, insurance, property taxes, and repairs. A well managed property, on the other hand, creates revenue for the owners. Depreciation and other tax write offs are further real estate investment benefits. Even in a rent control location, real estate that provides monthly rental revenue can increase with inflation, which is an added benefit. Another factor to consider is the tax implications of selling the investment. Capital gain taxes are usually levied when equities are sold. If you buy a new property after you sell your old one, you can defer your capital gains. This is known as the 1041 exchange in the tax code. Overall, both real estate and equities come with their own set of risks and benefits. Investing in the stock market attracts a lot of attention as a retirement investment vehicle, especially for persons who make regular contributions to a tax advantage account like a 401k or an individual retirement account IRA. Diversification, on the other hand, is critical, especially when saving for the long term. To limit risk, investors should invest in a variety of asset classes or industries. Investing in real estate is a great method to diversify your portfolio, lower your risk, and increase your rewards. It's important to remember that many investors invest in both the stock market and real estate. A REIT can be worth a second look if you enjoy the notion of investing in real estate but do not want to own and manage buildings. Thanks for watching this video and do not forget to subscribe to my channel.